Before I begin with the video, I want to wish everybody a happy new year and welcome back to the channel. In today's video, we're going to look at housing supply numbers, historical housing bubble prices, and the weakness in the labor market. By the end of this video, you should be armed with enough information to be able to debate your friends on how the weakness of the labor market and well-intentioned government policies is going to lead to a disaster in the housing market. Here's our first chart. It shows the monthly supply of homes. The shaded areas represent recessions, and the one commonality that we see with all of these is that the supply of houses peak in the middle of the recession. And it makes sense, right? People are either losing their jobs or taking pay cuts, and that puts pressure on them to sell their houses if they're under stress. Also, as the supply diminishes and the housing market gets stronger, the broader economy can also get stronger, thus taking us out of a recession. Well, it was common for all of these recessions except for our current one. Well-intentioned government programs that have halted foreclosures and evictions have kept the supply at a minimum. Because supply has been dropping the entirety of the recession, we've seen prices climb, instead of the natural forces taking the prices down. So this chart shows what prices did during the last housing bubble. We saw that prices dropped during the last recession. Right now, we're not seeing that. Currently, the price just seems to keep climbing and climbing. Since prices have been jumping, many people have positive equity built up into their homes. Once foreclosure protections end, there will be a tsunami of people forced to sell their homes. Look at how sharp this jump was from 2005 to 2009. Zoomed in, we see that it took 3.5 years to get to the peak. But there's every indication that this time, the climb in supply will be fast and furious. We've already had a year of pent-up supply kept out of the market due to the protections. We also have a labor market that is way worse than we have seen in decades, and I'll go over those graphs shortly. But before I do, let's look at the median prices of homes during the last crisis. Prices didn't immediately fall in 2005 as supply was ramping up. The bubble was actually just getting bigger. The crash was also rather short-lived thanks to the Fed's low interest rate policies. But let me ask you this. How low can interest rates go? Once the US dollar starts to fall in relation to foreign currency, we're going to see a pressure on interest rates to go back up. So now on to the weak labor market. Here's a historical graph of the labor force participation rate. I stopped caring about the unemployment rate because the powers that be do a great job of massaging the numbers in a way that makes it look good, but right now we are at 61.5% of working age people actually having a job. We have to go back to 1976, the last time we were that low. Zooming in, we can see that the labor force participation rate has been slowly and steadily declining since the dot-com bubble. In fact, it sure doesn't look like we've had any kind of a recovery since the Great Recession. We have to go back 34 years to see fewer women in the labor force. And with men, we are at an all-time low and getting worse. This entire decade has been particularly bad for 16 to 19-year-olds. There just hasn't been enough jobs for them. That and the college bubble has gotten them all into schools. So basically, anyone under 30 has experienced a horrible labor market and are loaded with student loan debt. This is the demographic that will be needed to power the next housing market. If they are unable to, then that's even more additional pressure downwards on demand. Found this chart on Zero Hedge. December was the first month we've shedded jobs since April. Zooming into the number of employees on payroll, it looks like we're potentially heading back down. I'm going to end the video with these two charts. First, here's a chart of the M2 money supply, the total number of dollars in circulation. The money supply has expanded this recession. Take a look at this. It has just ballooned out of control. Despite that, look at what's been happening with the velocity of money. It's been dropping. Money isn't circulating in the economy. It's sitting in the coffers of the big banks and big tech. And this is why the stimulus is failing to stimulate the economy. It helps asset prices jump, helps Amazon and Netflix, but it isn't helping mom and pop get rolling right now. So they may keep foreclosure protections in place for a very long time, which will no doubt encourage even more borrowers to stop paying. They may need to keep unemployment going on indefinitely, I mean, remember the 99ers from the last recession? We may end up getting more than 99 weeks this time. Interest rates may go negative. They are out of room to cut as it is. And if they do that, they will destroy the dollar. So in summary, we have a supply shock coming, interest rate pressures, and a horrible labor market that is going to take this housing market out. That is if they don't just inflate the heck out of the dollar. If they do well, then we're just going to have worse problems at the grocery stores and fuel pump. Thank you for listening.